Yo, what up? This is KMT the Ra, and welcome back to another KMT Productions video. So before we get started, I'm going to ask that you guys go ahead and hit that like button down below. It helps out with the YouTube algorithm, which basically means that the video will get more visibility the more you guys interact with the video. And if you haven't already, go ahead and hit that subscribe button and make sure that the bell notification button is turned on so that you'll always be notified whenever I'm going to be uploading new content. And with all that said, we're going to go ahead and hop into our next subject for today, which is investment funds. So we're going to go ahead and start from the top. What is an investment fund? An investment fund is a supply of capital belonging to numerous investors used to collectively purchase securities, while each investor retains ownership and control over its shares. Now, that seems a little complicated, but we're going to go ahead and break that down today. An investment fund provides a broader selection of investment opportunities, greater management expertise, and lower investment fees than investors might be able to obtain on their own. Types of investment funds include mutual funds, exchange-traded funds, money market funds, and hedge funds. With investment funds, individual investors do not make decisions about how a fund's assets should be invested. They simply choose a fund based on its goals, risk, and other factors. A fund manager oversees the fund and decides which securities it should hold, in which quantities, and when the securities should be bought and sold. An investment fund can be broad-based, such as an index fund that tracks the S&P 500, or can be tightly focused, such as an EFT that invests only in small technology stocks. While investment funds have been around for many years, the Massachusetts Investors Trust Fund is generally considered the first open-ended mutual fund in the industry. The fund, investing in a mix of large-cap stocks, launched in 1924. So we're going to talk a little bit about the difference between open-ended and closed-ended funds. The majority of investment fund assets belong to open-ended mutual funds. These funds issue new shares as investors add money to the pool and retire shares as investors redeem. These funds are typically priced just once at the end of each trading day. Closed-end funds trade more similarly to stocks than open-ended funds. Closed-end funds are managed investment funds that issue a fixed number of shares and trade on an exchange. While a net asset value, or NAV for short, for the fund is calculated, the fund trades based on investor supply and demand. Therefore, a closed-ended fund may trade at a premium or a discount to its NAV. Exchange-traded funds, or ETFs, emerge as an alternative to mutual funds for traders who wanted more flexibility with their investment funds. Similarly to closed-ended funds, ETFs trade on exchanges and can be priced and available for trading throughout the business day. Many mutual funds, such as Vanguard 500 Index Fund, has an ETF counterpart. The Vanguard S&P 500 ETF is essentially the same fund, but came to be bought and sold intraday. ETFs frequently have an additional advantage of slightly lower expense ratios than their mutual fund equal. The first ETF, the SDPR S&P 500 ETF, debuted in the United States in 1993. By the end of 2018, ETFs had roughly $3.4 trillion in assets under management. A hedge fund is an investment type that's distinct from mutual funds or ETFs. This fund is an actively managed fund made available to accredited investors. A hedge fund faces less federal regulation and is therefore able to invest in a variety of asset classes using a wide range of strategies. A hedge fund might pair with stocks it wants or expects to go up in order to decrease the potential for loss. Hedge funds also tend to invest in riskier assets in addition to stocks, bonds, ETFs, commodities, and alternative assets. These include derivatives such as futures and options that may also be purchased with leverage or borrowed money. We've talked a little bit about what mutual funds are, so let's actually break down them specifically. A mutual fund is a company that pools money from many investors and invests money into securities such as stocks, bonds, and short-term debt. The combined holdings of mutual funds are known as a portfolio. Investors buy shares in mutual funds. Each share represents an investor's part ownership in the fund and the income it generates. Mutual funds are a popular choice among investors because they generally offer the following features. Professional management. The fund managers do the research for you. They select securities and monitor the performance. Diversification, or not putting all your eggs in one basket. Mutual funds typically invest in a range of companies and industries. This helps to lower your risk if one company fails. Affordability. Most mutual funds set a relatively low dollar amount for initial investment and subsequent purchases. Liquidity. Mutual fund investors can redeem their shares at any time for the current net asset value, which is the NAV I mentioned before, plus any redemption fees. So what type of mutual funds exist? Most mutual funds fall into one of four categories: money market funds, bond funds, stock funds, and target date funds. Each type has different features, risks, and rewards. Money market funds have relatively low risk. By law, they can invest only in certain high-quality, short-term investments issued by U.S. corporations and federal, state, and local governments. Bond funds have more risk than money market funds because typically they aim to produce higher returns. Because there are many different types of bonds, the risks and rewards of bond funds can vary dramatically. Stock funds invest in corporate stocks. Not all stock funds are the same. Some examples are growth funds on stocks that may not pay a regular dividend but have potential for above-average financial gain. Income funds invest in stock that pay regular dividends. Index funds track a particular market index, such as the Standard & Poor's 500 index, also known as the S&P 500. Sector funds specialize in a particular industry segment. Target date funds hold a mix of stocks, bonds, and other investments. Over time, the mix gradually shifts according to the fund's strategy. Target date funds, sometimes known as life cycle funds, are designed for individuals with particular retirement dates in mind. So an important question to ask are, what are the benefits and risks of mutual funds in general? Mutual funds offer professional investment management and potential diversification. They also offer 3 ways to earn money: dividend payments, capital gains distribution, and increased NAV. So with dividend payments, a fund may earn income from dividends on stock or interest on bonds. The fund then pays shareholders nearly all the income less expenses. With capital gains distributions, the price on the securities in the fund may increase. When a fund sells a security that has an increased price, the fund has capital gain. At the end of the year, the fund distributes these capital gains minus any capital losses to investors. Finally, with NAV, if the market value of a fund's portfolio increases after deducting expenses, then the value of the fund and its shares increases. The higher NAV reflects the higher value of your investment. All funds carry some level of risk. With mutual funds, you may lose some or all your money you invest because the securities held by a fund can go down in value. Dividends or interest payments may also change as the market conditions change. A fund's past performance isn't as important as you'd think because the past performance is not going to indicate the future returns. By past performance, you can tell how volatile or stable a fund has been over a period of time. The more volatile the fund, the higher the investment risk, but it isn't the end-all be-all. You might be asking yourself, how do you buy these investments? Investors buy mutual fund shares from the fund itself or through a broker for the fund, rather than from other investors. The price that investors pay for mutual funds is the price that investors pay for the mutual fund is the fund's per share net asset value plus any fees charged at the time of purchase, such as sales loads. Mutual fund shares are redeemable, meaning investors can sell their shares back to the fund at any time. The fund usually must send you the payment within 7 days. Before buying shares in a mutual fund, read the prospectus carefully. The prospectus contains information about the mutual fund's investment objectives, risks, performance, and expenses. As with any business, running a mutual fund involves cost. Funds pass along these costs to investors by charging fees and expenses. Fees and expenses vary from fund to fund. A fund with high costs must perform better than a low-cost fund to generate the same returns for you. Even small differences in fees can mean large differences in returns over time. For example, if you invested $10,000 into a fund with a 10% annual return and annual operating expenses of 1.5%. After 20 years, you would have roughly $49,725. If you invest in the fund with the same performance and expenses of 0.5%, after 20 years, you would end up with $60,858. It only takes a few minutes to use a mutual fund cost calculator to compute how the costs of different mutual funds add up over time and eat into your returns. By law, each mutual fund is required to file a prospectus and a regular shareholder report with the SEC. Before you invest, make sure to read the prospectus and the required shareholder reports. Additionally, the investment portfolios of mutual funds are managed by separate entities known as investment advisors that are registered with the SEC. Always check that the investment advisor is registered before investing. So, that's pretty much going to do it for today's video. If you guys like what you saw here in the video today, make sure to leave a like and a comment down below. If you have any suggestions for any topics you may want me to talk about here in the near future, make sure to leave that in the comments down below as well. And if you haven't already, go ahead and hit that subscribe button and make sure the bell icon is turned on so that you'll be notified anytime I upload new content. Other than that, I will see you guys in the next video. Peace.